Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Earnings are a key market theme. Volatility might be coming up as a close second. Let's see what our panel members have to say today. Shiraz Mian, Research Director, Value Stock Strategist Tracy Reinick, and Growth and Income Stock Strategist Todd Bunton join us on the roundtable here. Shiraz, as far as the market themes are concerned, you say that the current bout of tentativeness in the market basically a function of growing uncertainty about the outlook for earnings.
That's right. The earnings results that we have seen thus far, I don't think they are as terrible as the headlines would make us think. From all the beat ratios, the growth rates, even guidance.
Guidance a little on the tepid side, though.
It is, but it was tepid in Q4 and Q3 as well, and that's made me scratch my head. There's not much on the head anyway, and the way I'm interpreting it is that it's the outlook for the rest of the year, particularly the back half, that the current results are making folks become uncertain about. So as I've been saying, quite often the consensus expectation is for about 1% earnings growth in the first half of 2013,
right,
and then a 10% earnings growth in the back half, and then another 11.5% growth in 2014. Now, when you see the type of soft results like we are seeing from Caterpillar, GE, IBM, and all the others, and you combine that with the soft economic data that we are seeing all around, particularly for the March data.
Housing data this morning as we sit here and speak.
Absolutely. So the industrial production, consumer, ISM, all the key data points, and not to forget the labor market, they are just connecting the dots. So if the economy is going into a slowdown, how can earnings grow at double-digit rates in the second half? And it's that reassessment that, in my judgment, is going through in the market right now.
Todd, you say earnings also having a big impact on the amount of volatility that we're seeing here.
Yeah. Finally, some volatility is returning to this market. I mean, I don't know about you, but it was all those steady.
Like it's a good thing. Todd.
Volatility is a good thing. If you're a value investor, volatility is great. It creates opportunities. It's those steady gains week after week that just make me nervous, because when stock market investing seems too easy, it probably is. And that's what it felt like in 2013. Everybody was making money in stocks because the rising stock market kind of raised all boats, even with poor stocks, poor quality stocks. So it's this increase in volatility. It's kind of a return to normalcy in the stock market. And I think if you're a long-term investor, embrace it and look for opportunities here and be comfortable with it. I am.
Well, Tracy says that these markets are getting whipsawed around more than just because of earnings, right, Tracy?
Well, I do think I partially agree with Todd. They are looking at the earnings picture and the guidance again, but I think there's all these other factors that came into play at least last week. We got the freak out on the commodities. It was the 2-day massive sell-off.
China GDP.
Yeah, the China GDP was the second one, or maybe that caused part of the commodity sell-off. I don't know. They're all seemingly interrelated. So those like little warning signs are kind of out there. That also played into with earnings.
That's
so
right.
They watched the earnings. They said, this isn't good. Everybody's selling every kind of commodity out there. They're getting out of that. So they got nervous, and you could see that in the volatility that was last week. A lot of the small caps, which I tend to watch, had a good bout of weakness last week, but they didn't completely break down. Yeah. So I'm still in the we haven't totally broken down camp yet.
And Todd, you look for even more volatility to creep in.
Yeah, absolutely. If you look, the VIX is still pretty low historically, and we're really just getting started with earnings season. A little over 20% of the companies on the S&P have reported. We get over 33% of S&P 500 companies reporting this week, and that doesn't even count the small cap stocks that usually go later on. And as Shiraz said, it's a lot about the forward-looking guidance here from management, because on a beat ratio, last time I looked, about 69% of companies on the S&P 500 delivered positive earnings surprises. Historically, that'd be a very solid earnings season, but it's that growth, and it's especially that second half growth that makes people worried. So we'll see what happens at the end of this week.
But are you hearing anything about the second half? Because I like surprisingly, in the ones I've had, like
No.
things are stable, but
Guidance
they're
has
not really
been
saying
guidance has been
anything.
pretty much in line from what I've seen.
That's
yeah.
right.
Yeah.
It's the key issue now is what the commodity markets is telling you about the global
Right.
economic outlook. And then you hear from some of these companies like GE, for example, or the major industrials that Europe is weaker
Right.
than the weak picture that we all knew about. And somebody like even McDonald's would have
Yeah.
a problem with this kind of a thing. So it's the commodity complex telling us more how weak the economic picture is, and then investors are tying that in to the earnings outlook. So managements are not telling us
No.
that the second half is weak, but the market is struggling with it, that's.
And so as the market struggles, investors struggle too. How can investors hedge themselves? You say stay defensive.
That's right. And I have been talking about these large cap dividend pairs, preferably in some of these sectors that are doing very good, actually. The staples and the healthcare and the utilities. These are not growthy areas of the market where you go in looking for growth opportunities, and not exactly valuation plays either. They're just a place to hide in. And if you can have 2.5%, 3% yields on some of these stocks, that, in my judgment, is a good enough place. Though that has been the happening place in the market lately. Everybody has been taking shelter there.
Tracy, you say check out the big dividend yield stocks.
Well, yeah, even bigger than the 2 to 3%. I have seen some rotation even in my own portfolios into the 8 or 9%, like the really huge, mainly MLPs. They're paying out all their earnings to the shareholders. But when people get nervous,
That's right.
7 or 8%, it looks pretty good. So they're starting to pile into there, and that is some place you could also hide out.
Todd, what say you?
I would agree with the dividend stock theme, with the high yield theme, but I'd also preface that with look and wait for companies to report earnings this quarter, and look for companies with solid earnings momentum. You don't want to buy a stock right before it reports earnings and hear that the outlook's bad and the earnings estimate picture tanks. So look for solid earnings momentum as well, but search for yield, of course.
Oh, okay, we have to leave it right there. However, these folks have more to share with you in the form of top picks for this week, and that is in our next segment.